Hey everyone, I was talking with an investor last week and he said something that caught my attention. It's actually something I've heard from investors before. Usually it comes from private investors who've been in the business a long time. The investor I was talking to said he doesn't want to buy real estate in the city we were talking about because it's too expensive. He thinks prices have gone up too much. That statement really struck me because I believe that the market we were talking about still has considerable runway. The disconnect really boils down to perspective. In that investor's mind, real estate in this city is too expensive because it costs more than 2.5 times as much today as it did 5 years ago. But is that the best way for investors to make investment decisions? Here's the disconnect. That investor is thinking about the relational value of the property itself, the quality and price per foot compared to what it used to be. Instead, and what I told him was that he should focus on two things: the value of the cash flow from that property today and the value of the cash flow at a future disposition date. What that property cost yesterday or last year in the midst of the pandemic or 5 years ago or in 2010 right after the financial crisis is actually irrelevant. What really matters is what you can buy the property for today. How much cash will it take to buy it? What the rates and terms will be for a loan? What the cash flow is today, what the cash flow will be in the future, and what the terminal value will be when the investor eventually sells it. None of that actually has anything to do with what the price was yesterday. My point is that just because the price of a property has risen dramatically doesn't mean its value cannot or will not continue to rise. Let me give you an example. In the last year, the price of apartments in Phoenix have risen by about 35%. That's huge. That means if a building cost $10 million a year ago, it would be about $13.5 million today. But is $13.5 million too expensive for that apartment building when you could have bought it a year ago for $10 million? Maybe, but in the last year, apartment rents in Phoenix went up 25.7% and the vacancy rate went down from 3.9% to 2.6%. So apartment cash flows nearly kept up with the appreciation in the Phoenix market. But what about next year? And the year after that? And the year after that? That's where research comes in, looking into the future. Just because property values went up a lot doesn't dictate what they'll do in the future. That's where investors will place their bets based on their best estimate of the future returns on a piece of real estate. A property may have gone up by 30% in the last year, but it could go up even more in the future, or it might not. All of that being said, there have been some big price moves over the last year. Appreciation has been strong in numerous markets and property types. Here are some of the big movers according to Real Capital Analytics. The apartment sector has been led by Phoenix, as I mentioned, with the average price in third quarter up 35.4% from last year. Memphis is up 30.9% and San Antonio apartment prices are up by 23.4%. For retail properties, the biggest gains were in Tampa, up 20.1%, Philadelphia, which is up 17.6%, and Phoenix is up by 16.5%. Office has been led by Atlanta, where prices were up 32.1%, followed by Palm Beach County in Florida, where office properties are up 16%, and Cleveland with gains of 15.1%. And finally, industrial properties. Phoenix is up by 30%, Atlanta is up by 24.9%, and Broward County in Florida is up by 24.6%. Commercial real estate value gains in the last year have been huge in several cases. But remember, prices were pretty soft last year. We were in the middle of a pandemic-driven economic lockdown after all. And at the end of the day, we always have to remember one thing. Commercial real estate is a long-term investment with values driven by long-term returns. To make the best decisions, you have to keep your eyes on the horizon.